Welcome back to Investing Talk podcast.
Today we're looking at Intel.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis, and I think we really should start by framing this whole story.
Okay.
What we're seeing with Intel right now is it's just a phenomenal turnaround. It's a huge structural pivot they're executing under that IDM 2.0 strategy.
Yeah, I mean, this isn't just a small course correction. It really feels like a total reinvention.
It is.
And the market has definitely been paying attention. I mean, you just look at the price action. The stock gained, what, an impressive 84% over the trailing 12 months?
That's right, leading up to January 1st, 2026.
That kind of move is just a massive vote of confidence, right? It shows investors really believe management can stick the landing on this pivot.
Well, that confidence seems to be rooted in two main pillars. You have this aggressive technological execution and then just really rigorous financial discipline.
Let's maybe start with the finances then.
Sure. So if you look at Q1 2025 revenue, it was basically flat year over year, around $12.7 billion.
Which on the surface sounds a little soft.
It does, but the real victory there is the operational efficiency, especially when they're in a period of such massive capital expenditure.
Right, the focus on OpEx. I'd argue that's even more important than top-line revenue right now.
Why is that?
Because it's the clearest signal we have of a margin recovery. They cut annual operating expenses to $17 billion in 2025. And they've publicly committed to driving that down even further to $16 billion in 2026. They're literally cutting fat while building these brand new world-class fabs.
Exactly. And that's the difference between just spending money and executing a disciplined capital allocation plan. Free cash flow isn't just getting burned.
No.
It's being intentionally directed right back into executing IDM 2.0, that's their integrated device manufacturing plan, while still keeping their commitment to shareholders.
And this is a crucial point. This massive strategic shift is not happening in a vacuum.
No, not at all. It's heavily subsidized and supported by the U.S. government.
That financial backstop feels foundational to the whole investment thesis.
Oh, absolutely. We're talking about $8.9 billion secured through CHPS Act direct grants and equity.
Which makes Intel the single largest recipient in the United States.
It does. And this isn't just cheap capital. It fundamentally de-risks their construction timelines, and it lowers their long-term cost of production.
Does that government backing come with strings attached? I mean, that much money has to change the dynamic.
It does, but in a good way for them. It signals that the U.S. government views Intel as a strategic asset, almost like a national utility.
Okay.
So the grants require domestic production commitment, sure, but the trade-off is invaluable. It cements their role as the national champion for sovereign silicon.
And then you add that high-margin $3 billion U.S. defense contract, the Secure Enclave deal.
That is incredibly sticky business. It ties Intel directly into the national security infrastructure.
It gives them a reliable, high-margin baseline of revenue that's, way less susceptible to the swings of the normal PC market.
Right.
It provides a stability that few other chip makers have.
It's a truly reliable base layer. And if you connect it all back, the financial discipline, the cheap TT's funding, the defense contracts, it all serves one goal.
Right.
Making their core technological advantage, the Intel 18A process node, profitable and globally competitive.
Okay, so let's unpack that because 18A is the real battleground. We hear the term thrown around constantly.
Right.
What actually makes this 1.8 nanometer node technically superior?
It boils down to a key innovation called PowerVia. It's their backside power delivery system.
Right.
So think of a modern chip like a really dense city. You have data lines, which are the roads for information, and power lines, which keep the lights on.
Okay, so a congested city street.
Precisely. Traditionally, both of those run on the top layer of the chip, which creates, traffic jams and interference.
Makes sense.
PowerVia is like a massive infrastructure project where they've tunneled the power lines underground to the backside of the chip.
So it completely separates the power from the data.
It radically cleans up the front side, yeah. It allows for denser transistors, higher performance, better power efficiency. In terms of architecture, it really does position them ahead of their competitors.
And this ties directly into that geopolitical strategy you mentioned. It's not just about raw performance.
Not at all. It's about sovereign manufacturing capacity. It carries this geopolitical premium.
How do you even quantify that premium? It seems huge.
It's huge, but you can try to quantify it through risk. In a world of deglobalization and onshoring, having guaranteed U.S.-based high-volume manufacturing is a market shield.
So for a Department of Defense contract or a major cloud provider, they could be mandated to source their chips entirely on U.S. soil.
Exactly. And that immediately restricts the competition, potentially shielding Intel's market share from rivals like TSMC.
So being the national champion is like an invisible moat against supply chain chaos and political risk.
That's the strategic asset, yes. And they're not stopping at 18A. They're already planning for the deployment of high-NA EUV for the next-gen Intel 14A node.
Which is expected in 2027.
Right.
So for those of us not deep into photolithography, what does high-NA EUV mean in simple terms?
It just means higher resolution lenses. Think of it like moving from an old camera lens to a much sharper, more precise one.
You can etch even finer, more complex circuits onto the silicon.
You got it. It shows they're not just playing catch-up. They're proactively investing to stay at the technological forefront for the next decade.
Okay, so that's the tech foundation. Now let's talk about the immediate payoff. If 18A tech is the engine, then the AI PC replacement cycle is the huge market catalyst.
This is the massive wave driving their client computing group, the CCG. The focus is shifting dramatically from cloud-only AI to edge AI.
Meaning the intelligence runs locally on your device.
Correct. And the projections are staggering. Something like 60% of all new PCs are expected to have dedicated AI hardware by 2026.
Which requires a whole new architecture. That's where Intel is staking their claim. Why the sudden shift to the edge?
It comes down to latency and privacy. Running AI on your local machine means instant responses, and your data never has to leave your device.
Which means you need a dedicated NPU, a neural processing unit, right on the chip.
And that creates an urgent need for corporations and consumers to upgrade their entire fleet. It's a real replacement cycle.
And we saw the tangible result of this at CES 2026 with the Core Ultra Series 3 processors.
That launch was so critical. It was the first AI PC platform using that 18A technology. The market saw it as proof that their ambitious timeline is actually on track.
And these new processors are set to power over 200 different PC designs.
200, that's massive volume. It rapidly establishes the 18A platform as the standard for the next generation, for models like the HP EliteBook.
So the market sentiment was obviously bullish after that.
Overwhelmingly bullish. Analysts are taking note of this concrete high-volume execution. And that sentiment is just further bolstered by the development of the future Panther Lake AI chip.
Right, which reassures everyone that they have a long-term roadmap against rivals.
Exactly.
So let's shift from their internal business to the external opportunity. The independent Intel foundry. This is the real upside liver, isn't it?
This is the inflection point. This is what takes them from being just a component supplier to a true global infrastructure provider.
And the growth forecasts are pretty wild.
They are. Some analysts are anticipating that foundry revenue could potentially double by 2027. And that's not just hope. It's driven by real custom chip backlogs they're building up.
So who are the big external customers validating this?
We know for a fact that Microsoft is a key client. They're using the foundry for their MAIA accelerators.
Okay.
And there are constant rumors of other backlogs growing, maybe with players like Amazon for their custom silicon.
But the big one, the speculative catalyst everyone whispers about, is the idea that NVIDIA might shift some production to Intel.
That's the white whale.
Why would NVIDIA ever do that, though? They're so deeply entrenched with TSMC.
It comes down to hedging risk and, frankly, appeasing U.S. regulators.
Wow.
The theory is, as NVIDIA completely dominates the AI chip market, regulators get more concerned about the concentration risk of relying almost entirely on TSMC in Taiwan.
So if NVIDIA moves even a small percentage of its production to a U.S.-based foundry like Intel's, it's a smart geopolitical move.
It's a geopolitical move disguised as a supply chain decision. And if that happens, that high-margin revenue would instantly transform the foundry's growth trajectory.
That would be a game changer. So let's talk valuation, because even after an 84% run-up, some analysts still call the stock so cheap compared to TSMC. How is that possible?
That's a great question. The perceived discount ties directly back to IDM 2.0. You have to look at Intel as a sum-of-the-parts business now.
Not just a legacy PC chip maker.
Right. You're buying the client computing group and the data center group, but you're also getting the foundry business, which is still valued like an emerging entity, not an established giant like TSMC.
So the market hasn't fully priced in the future value of the foundry business yet.
That's the theory. And from a technical standpoint, analysts are really encouraged by the stock forming these clear, higher highs post-turnaround.
I've seen a lot of talk about The price action forming a cup and handle resolution. What does that signal?
It's a classic continuation pattern. The cup is that big consolidation and recovery phase, the turnaround itself. The handle is a smaller, brief pullback.
Okay.
When the stock breaks out of that handle, it suggests massive accumulation is happening. It suggests the technical story is finally aligning with the fundamental one.
But no story is without risks. You flagged two primary ones. Let's start with the AI PC cycle possibly slowing down.
The first major risk is memory shortages. If the supply of crucial components like DRAM and NAND stays tight, that could inflate PC prices.
Which would slow down the upgrade cycle.
Potentially. If the final sticker price on a new AI PC gets too high, some consumers and businesses might delay buying.
But isn't the counter-argument that the new functionality is so necessary that people will pay anyway?
That is the crucial mitigation factor, yes.
Yeah.
For high-end users and corporations, the ability to run local AI models, the security, the real-time functions, they need the NPU. It's not a luxury.
Okay, what about the internal risk? Building a foundry is insanely expensive.
Right. The second risk is foundry profitability delays. Hitting that 2027 profitability target requires landing those massive external customers.
Like the theoretical NVIDIA deal.
Exactly. If those contracts don't materialize fast enough, it could create a drag on margins.
So the risk isn't if they can build the fabs, but how long the payback period is.
Yes, but again, there are strong mitigation factors. That $8.9 billion in SUCHEPS funding is a massive safety net.
And the sticky defense contracts provide a stable revenue floor.
Correct. It gives the foundry time to grow its external customer base without existential pressure. The risks seem manageable as long as the 18A execution stays on track.
So let's look at the near-term calendar. Next 3 months, what should we be watching?
The immediate focal point is the Q1 2026 earnings results, due in late April. The Street needs to see proof that the AI PC ramp and initial foundry wins are finally driving revenue growth.
We need to see that machine start to spin faster.
We do. And on the product side, we need to watch for the start of Panther Lake shipments, which should begin in late January. That's the next-gen AI chip.
And on the macro level.
The tailwinds are just undeniable. You have the AI infrastructure supercycle, which benefits all semiconductor companies. Plus, you have this broader sector rotation into U.S. champions for stability.
So tying it all together for the listener, 18A leadership, the geopolitical mode, the AI PC wave. What's the thesis?
It creates a really compelling, multifaceted investment case. You have clear technological leadership with 18A. You have that geopolitical moat making them a strategic U.S. asset. And it all points toward capturing this massive wave of AI PC ubiquity and the long-term potential of the foundry.
So this isn't a short-term trade. It's a structural play that needs a multi-year time horizon.
Absolutely. The thesis really supports a multi-year hold into that expected foundry profitability around 2027. You're investing in the transformation from a legacy chip company into a secure, integrated device manufacturer and a major global foundry.
That gives you a fantastic framework for assessing Intel's resurgence. The final provocative thought for you to consider is this. As the world continues to deglobalize, how much non-negotiable geopolitical premium should you assign to a company that controls the national supply chain of the world's most critical technology?
And whether that speculative NVIDIA hedging relationship is already starting to heat up behind closed doors, that's the massive long-term catalyst.
Always more to learn. Thank you for joining us. Remember to subscribe so you don't miss our next analysis. Keep learning, and we'll catch you next time.